Alright, folks, welcome back. It's currently 1:37 a.m., in which I should be asleep, but I'm not because I'm not gonna say I can't go to sleep, but my body won't allow me to, and I'm bored. So I was like, might as well record because I got nothing else to do. I might just stay up until 5 a.m. and just finish this whole chapter out. We got like what 11, 12 episodes left. It's not too much, but anyway, in this episode, episode 37, we're gonna be going over institutional order flow entry drill. I did teach you, I think in a previous episode, about equilibriums of order blocks and ranges and fair value gaps and stuff like that, and imbalances. Since you know about that, I did mention a technique of the fair value gap of when it does not even touch the equilibrium, in which we're going over that today. You've technically already learned it, but we're going to go over it directly, okay? Because we were going over it indirectly in the previous episode because it was, a totally different topic. But now we're going over institutional order flow entry drill, okay? Now, institutional order flow entry drill, think of it as this. If I can like draw a little fair value gap for you. So we got one candle here, one candle here. Oh, a little too thick. There you go. And then another candle like that, right? So obviously you can see the fair value gap is right here, right? Let's say price drops back down into this gap like so, right? For it to be an institutional order flow entry drill, what we must not do is hit the equilibrium at all. Okay. When prices retracing into this gap and touching it, hitting it, referring to it, and there should be a reaction off of it, it should not hit that level. Why? Why shouldn't it hit that level? I said this in a previous episode. The reason it should not hit this level is because if price really wants to, for example, seek, I don't know, this random level buy side liquidity up here, if it wants to seek that, it has to do it quickly, right? If it wants to do it quickly, it has to do it with what? Displacement. Duh. So when displacement occurs, there's going to be fair value gaps being created, in which one of the rules of the market is to what? Fill imbalances, okay? Or rebalance imbalances, in which is going to do that. But whenever price is running to liquidity, because that's the number one thing to seek liquidity. Number two is to seek imbalances. So that's just that the first priority, number one priority, seek liquidity. Second priority, or I think that's it. Yeah, second priority is to rebalance imbalances, and then the third priority is to rebalance to an equilibrium of a dealing range. Okay, so rebalancing imbalances is only the second priority that it has. So if it's seeking liquidity and we have this gap here, it's not going to sit here and drop all the way back down just to fill this thing. It's going to offer short-term rebalance. That's not officially what it's called, but it's just those words put together make it make sense. Okay. Those words together to just make it easier for me to explain it to you. It's offering short-term filling of this gap. Okay. Short-term sell side delivery. Because mind you, this is a bullish fair value gap. So there's only buy side delivery within that range. So it's offering short term sell side delivery to the participants that did not get a good fill here, or the side of the market that has not been filled here. So it's offering that short term fill to then go back higher and hit, or purge or seek that buy side liquidity. So that's what an institutional order flow entry drill is. In short, that's literally all it is. It's just it touching a fair value gap and not hitting the equilibrium. Simple. You can click off this video right now if you wanted to, and you would know it. I can click, what is it, F8? I think that's a shortcut to stop the recording, and I can end it here. But I'm not going to. I have to show you some examples to at least be a decent teacher. So let's not do that. I think I have a couple examples here on the 15-minute. This price actions have been so ugly, so you can barely find any of these things. But anyway, I did find one here earlier. Oh my God, JJ's preparing his videos. This guy has no clue what he's talking about. He cherry picks examples. No, this happens almost every single day, but not with this market. This has not been happening every single day. Anyway, as you can see, you got first candle, second candle, third candle. Third candle's high, first candle's low. That's the fair value gap right there. Okay. We retrace up into the gap, respecting it, as we can clearly see. Bodies close right below it, and the wicks, it's just showing that it wants to reject off of it. But look what it did exactly. We did not, when I say did not, we did not hit the equilibrium. So Since we did not do that, that is telling us that, oh, price is really, really aggressive today. It really does not want to rebalance and balances. It's just, it's ready to go. It's ready to move. That's what you want to see. You want to see it leave gaps open when it's seeking liquidity, because what that's basically telling you is the algorithm is in a stage of aggressiveness or aggression and speed. That's what you want. You don't want to see slowness and delay. I guess you can say those terms. You don't want to see that. What you want to see is this right here. Retrace up. Oh, stop right there. Drop. Simple. And I think it did it again here. Let me see. Did it? Oh, almost, but it did hit the equilibrium on that candle. Barely hit it. So you get what I'm saying, and just look at the reaction of how it reacted off of that fair value gap. We tap it, institutional order flow entry drill, or I can just mark this as entry drill right here. IOFed, there we go. Entry drill. And look how price just moves away from it beautifully too. From there to there, it did 225 points in a matter of 45 minutes. Wow. Pretty cool, isn't it? Yeah, I know. Very, very cool. Now, what is the liquidity that it sought? You're probably like, okay, we dropped. We used institutional order flow entry drill to drop, but what liquidity did we seek? You see these equal lows right here? If I can even mark it, hold on. See that? That's what it sought. Entry drill, drop down into sell side liquidity. Amazing, isn't it? Yeah, I know. Honestly, this is a very, very simple concept. I'm only going to find one more example, and I'll be ending this here because, like I said, it's 1 o'clock in the morning. Well, going on 2 o'clock in the morning, and I really should not be awake. So I'm going to try to knock these videos out as quick as possible without talking too fast and sounding like a total idiot teacher. Anyway, here's one institutional order flow entry drill. Wasn't too much of a reaction, but it did eventually reach some form of liquidity, which was that short-term high there, but you can clearly see it. It's right here. Wait, was that? No, it was this right here. Okay. My bad, y'all. My bad. All right, so you can clearly see the gap. First candle, second candle, third candle. Did we come back down into the gap? Do we hit the equilibrium? Nope. Look at where the bodies close. They close above the fair value gap, closing nowhere inside of it. So there's a lot of respect going on here. Price is really referring to this, in which we do jump up. Right after we touch it, we jump up immediately. Time to store a little bit, come back down, take out that low right there. Then we jump up again. Boom. And I think that's when we finally hit our target around there, that little spike up right there. Well, not target, because we don't even know if we would have targeted this. There's that buy side liquidity that it hit. Well, it's now liquidity purge, my bad. Liquidity purge, hits it, then drops. Pretty cool, isn't it? Yeah, I know. Very, very cool. I'm gonna try to find one, just one. I'm sorry, I don't want to make this any longer than 10 minutes. Oh, there's one. Here we go. Oh, wow. Wow, look at that. Barely touched it. Look at that. From here to here, I think that's about, wow, one tick. See that? You see this, right? This isn't, this might be hindsight, but this is real. This is even very impressive for the market to perform this way in hindsight. You're gonna see. Just me teaching you this and actually seeing it in hindsight instead of live price action is still very impressive to me to this day. I've said that hundreds of times, but it still shocks me. Anyway, you see the gap, first candle, second candle, third candle. We go up, trace back down into it. No bodies close inside of it. We have the respect of that major respect of that gap, creating an institutional order flow entry drill, in which we have a bunch of buy side liquidity, especially up here because it's above this accumulation here. So we can mark that accumulation high there. I can mark it as buy side liquidity. There we go. In which after that we time to start a little bit before 9:30. This is pre-market, by the way. I forgot to mention that. Yeah, that is pre-market. So pre-market accumulates, and then 9:30 kicks in. Boom, jumps up into the high. Pretty nice, isn't it? Yeah, I know. Anyway, that'll be it for this very, very simple concept. I don't want to make this video more than 10 minutes long because it does not deserve it. And I guess I'll see you in the next episode. Good luck and good trading.